So first thing you do is you calculate that adjusted EBITDA average and your liquidation value. I'll show you the process, then we'll do an example. Second is you determine the market multiple from deal stream. Number 3, do the transfer analysis. Look at the employee, customer, structural, and social goodwill and the value. Then you can analyze the seller psychology, calculate the MUD scores and the RLEV scores. And then you can look at how the deal structure that you're proposing is going to adjust the valuation. So let's look at the business that we originally went through. So again, it was $2 million in revenues, $300,000 of EBITDA. We looked at the average. We took the 3-year average because it was on an uptrend, 355. And then we looked at the liquidation value being worth about $400,000. Then we went back to deal stream. Now, this is a marketing agency, for example. Is it a marketing agency? Yeah, it's a marketing agency. So we know that on average, it's going to have like a 3.6x multiple of adjusted EBITDA. And then let's look at the transfer value. So let's say it was a 5 for customer, a 4 for employee, a 3 for structural, and a 3 for social. So it's below average on structural capital and social capital. It's above average on employee, but really good, strong customer capital. So that's giving us a 62.5% transfer value score, which is 15 out of 24. And that places the business right bang in this industry average multiple range. So in this example, this is a very similar business to what I'm looking at inside of KOD. You wouldn't make any adjustment in valuation based on the transfer value. But when I show you the model in a minute that I built for you that I'm still testing, you'll see by changing some of these scores, it can drive that business down into that liquidation value only zone. So if you're worried about transfer value, you can score it and then you can see how the valuation is going to change. Okay, so we had the 355 of recasted EBITDA, 3.6 times multiple, which we got from deal stream. So now we've got an enterprise value of just under 1.3 million, the same adjustments that we made before. So now the equity value of this deal is 1.213 million. It's gone up from the original analysis because we're using that 3.6 multiple. So that's the financial valuation. Now let's look at the rest of the analysis. So 1.213 is the new valuation, 400,000 is liquidation value. So now we've got $813,000 of goodwill, and the goodwill is distributed across the 4 pillars in that way. So most of that value, a lot of that value is coming from the customer because that's scored really high on the transfer scale. Next was employee, and then a little bit scattered across structural and social. If we look at the RLEV scores, we were at 73% on the MUD score, which was high, 82.5% on the RLEV score, which was really, really high. So 78% was the average. We overlay that onto the model, and I've built the model for you so you don't have to do it. That puts us kind of at the lower end of that range. So we're at about 2.8x as it would hit the algorithm in my model. So that would imply about a 16% discount to the original valuation. So 1.213 was the new valuation, but because the seller psychology is on the high side, we're going to get a discount based on the mathematical modeling of all the other deals that I have done. So that's bringing the valuation back down to somewhere around the $1 million mark. Then when we apply the deal structure, that $1 million valuation is now what's going to sit in the midpoint of our structure curve. If we were to do an SBA deal, we would venture much lower down to the lower multiple scale, because remember, the more that we pay on closing, the less the total valuation. So if we were going to be paying on average a 3.22x multiple for an LBO, we're going to be paying just under 2.5 times if we're doing an SBA. And then if we're doing an annuity deal, it's going the other way. So an annuity deal would be a higher valuation. It would be close to 1.3 million and slightly above a 4x multiple. So this is the summary. We know that our base valuation was 1.213. That was driven by the math and by the deal stream multiple. We know that gave us about $813,000 of goodwill and $400,000 of liquidation value. We applied the customer, employee, structural, and social pillars. That actually didn't change the valuation because we were in that average zone at 62.5%, so no change. We then looked at seller psychology. That was really high at 78%, so that gave us a discount and brought the valuation back down to close to $1 million. And then when we looked at the three structures, the 1.024 would be the LBO model, 785 would be your SBA valuation, and 1.297 would be your valuation if you were going to have no closing payment and you were going to go down the straight 10-year annuity. So what I've done, guys, we'll take some questions in a minute. What I've done, and I'm still testing it, is I built you a model. I built you a model so you can do this. You can put your 3 years of revenue and adjusted EBITDA in there, put your market multiple in from deal stream, take the cash, real estate, and long-term liabilities straight out of the balance sheet. You can put your balance sheet net asset value in there, and it calculates the liquidation value. These are different numbers to the one I've just showed you. I've been playing with this model. So it calculates the equity value for you. It then looks at transfer value. So in this example, best in class business scored 5 out of 6 for customer, 6 for employee, 5 out of 6 for structural, 5 out of 6 for social, 87.5%. And remember, the model tells you what the premium is going to be. So it's doubling the transfer value because it's got all these amazing things going on. If you drop this down and say, well, customer was a 2, maybe employee was a 3, now it's only at market value, structural was a 2, now it's discounting it, it's getting lower and lower to liquidation value. Look at this. We only scored 9 out of 24. We only have a 37.5% liquidation, transfer value now. So we're at liquidation only value. The model's telling you, guys, don't pay any more than 320 grand to buy this business unless you're doing an annuity. You can put in the MUD scores, the RLEV scores. So that's going to apply an even bigger discount. So it's going to knock about 7% off the price based on where the seller psychology ranks in terms of that model. And then it calculates what the 3 valuations are for you and then summarizes them all there with the valuation and the deal structures and the amount of closing payments. So I'm going to have another little play with this. I only built this today and I want to battle test it for you, but hopefully I'll get this out for you in the next few days. So loads of crazy numbers in there, loads of crazy stuff, but I hope you found that useful. And even if you don't apply all of this when you're doing your deals, I just wanted to kind of show you that valuation isn't only about numbers. You can think about deal structure, you can think about seller psychology, and you can think about the transfer value of a business and how that can drive the valuation up, or if it's a terrible business, how it can kill it based on those 4 pillars that we talked about. So thanks, guys.